What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey. Today, we're joined by Kurt Lewis, Head of Central Bank Policy at Piper Sandler, and someone who's been in the room where it happens. Kurt spent nearly 20 years at the Federal Reserve, most recently as Special Advisor to Chair Powell and previously to Vice Chair Brainerd. From the financial crisis to today's policy challenges, he's had a front row seat to how the Fed thinks about growth, inflation, and financial stability. Welcome, Kurt. Really excited to have you join our podcast. You recently joined Piper Sandler as Head of Central Bank Policy. You've got a long career at the Fed working with several prominent folks. Beginning of your career, you had worked with Roberto Perley, good friend of ours, who was the head of policy in your seat back in the Cornerstone days and during the transition into Piper Sandler. Most recently, you were a special advisor to Chair Powell. So as we were talking ahead of this, you mentioned that you joined working with Roberto right near the onset of the financial crisis. You were in a group, and the name of the group was Monetary and Financial Stability. And you joined that group right before the global financial crisis. So I think that's a good place to start. I'd love to hear some stories about that. And then, of course, I'd love to hear what it means to be a special advisor to Chair Powell.
Thanks for having me. It's great to be here. Great to have joined the team. To go back to the very beginning, yes, I was wooed into the Federal Reserve by Roberto Perley, just coming straight out of graduate school. So after I finished my PhD, I joined the Fed. I joined in July of 2007, so just before the onset. I think a lot of people still flag it was a BNP fund that went down in August of 2007 as like the beginning of the financial crisis. But I started there in that group, Monetary and Financial Stability, and I had come with a sort of a macroeconometrics background. And we were going to start doing a lot of vector autoregression stuff to combine financial and macro data. And then the crisis hit, and we became overnight a very financial markets, banking sector, contract, like how do these things work group. Obviously, there are banking groups, there are capital market groups, there are these other things within the Federal Reserve, but it was an all hands on deck thing. And so the funny part of that is that despite having all of this sort of Bayesian econometrics macro background, the first time I stood up to answer a policymaker question during a board briefing was to talk about how CDS contracts work. I think the first real policy work that I did that got in front of policymakers was I just started making a list of all the write-downs and capital raises at the largest banks. And anyway, it was a very different beginning than I was anticipating. But basically, I guess another way of saying that is that I've been at the Federal Reserve, or I was at the Federal Reserve for the fun part. I missed the great moderation, and I joined right before the chaos ensued and the balance sheet got big and people had to start figuring out what parts of markets we hadn't been paying attention to that we needed to.
I would say you missed the easy part of being in the Federal Reserve during the late 80s, 90s, and early 2000s. But that goes to your skill set and your knowledge, working in a really challenging environment where everyone's on a learning curve, no matter how long you've been doing it. So I would say that that's an asset to have for folks that are in their 40s and 50s and really started their career off back in that time. So you then worked for several different folks at the Fed. You worked for Vice Chair Brainerd between 2020 and 2023. Tell us a little bit about that. That was another fun part, as you call it.
Yeah, so I moved around, just to fill in the gaps a little bit. I moved around a lot inside the board. I moved around to various groups inside of the Monetary Affairs Division. I spent a year in research and statistics as well. I spent a lot of time in both what we call the financial side and the real side inside the board. The real side is more consumption, investment, the standard macro, nip the table type data. And the financial side is everything in the markets. After doing a lot of that, I had a very broad, less deep background than some people get at the Fed. which I do think was a plus when it was time to start doing some of these things. I started working as a special advisor to then Governor Brainerd in, I think it was September of 2020. I got a phone call that said her advisor had taken a different job and had started to assume that job. And I had been in the process of applying for this role and found out that I had got it and that I was starting that day. And it was just going into the September 2020 round. Fortunately, the person who had previously been in the role has helped set her up already for that spot. But yeah, we were all fully remote. I'm assuming you guys probably were at that point too. That's our late 2020 era. And I had been in rooms with her before, but one-on-one meetings were like not super common. So we met over, at that point, I think I think the board was using Skype.
I was gonna ask, what was the technology the Federal Reserve was using for you guys to have all these meetings?
We were using Skype and conference lines, I think, like conference call lines for the vast majority of the beginning. And then we moved to other Microsoft products, eventually settling on Teams. But there was a lot of phone calls sitting at a card table, like everybody else. My COVID story is I set up a card table in the corner of our bedroom so that I had a window on either side and had a monitor and a clicky keyboard that drove my wife nuts. And she was like, I'm sorry, at 11:30. At 11:30 every night, this stops no matter what. That was our COVID years. It's a really interesting time. So being a special advisor to governors or being a special advisor to policymakers is really about being a high touch contact. It's, I need to get this question answered. I need to know what is the staff thinking about this part of the labor market. Why is the inflation forecast this way? I saw this outside piece. Do we agree? Do we disagree? Let's just have a conversation about how I'm thinking about what the outlook is shaping up as. You help them craft their remarks for the FOMC. You help them write external remarks, so speeches, things like that. And just be a sounding board for all of their thoughts about policy and the economy and stuff like that. All of what they want to share about policy, the economy, and in general, be a resource that's very familiar with their thinking so that when things are coming up from the outside, you know what things to surface with them. So it's, you'd be interested in knowing how this part of the staff forecast is evolving, or I saw this outside note on an aspect of the labor market or inflation or personal consumption or something like that. And I know you were interested in this. And you build that relationship up over time. And generally speaking, those roles are 2, maybe 3-year type jobs. And so you have time to build that up and work together. Obviously, the organization as a whole faces the policymaker, but they benefit from having a single person that they can look in the eye and be like, this doesn't make sense, or I disagree. Who do I talk to about what my view is versus the staff view, and find out why they think what they think, stuff like that. So it's a very fun role because you get to see everything and you get to have a conversation with, I would argue, one of a relatively small group of some of the most important economic policymakers in the world. And when I was getting my PhD at the University of Iowa, I didn't know I was going to have that kind of an opportunity. And so it's been that was a great experience. So Governor Brainerd became Vice Chair Brainerd in, I want to say, 2021, I think. And I stuck on with her. And then in 2023, she left to go run the NEC. And what happened just coincidentally at exactly that moment in time, a special advisor to Chair Powell, a guy named Josh Gallen, became secretary of the FOMC. And I was asked, hey, can you sit with Jay for a little bit, see what he thinks, and if he can work with you, because I had already been familiar with what these roles are. And we had a conversation. I started helping him out at I think it was the March 23. Yeah, because it was right after SBB. So it was the March 23 round, and it was supposed to be a very short-term gig. And after 6 months of working with him, I went back to the chief of staff and said, so is this just my job now? And she was like, oh yeah, sorry, we thought you knew. And he left, this is going great. Let's keep going.
That's amazing.
Anyway, I started working with Chair Powell in early 23 and kept doing that basically through January of this year, and stepped aside as I started to consider outside options like this one.
I love your background. That's so interesting. if you went in the Wayback Machine. How does the Fed talk about things in hindsight? Obviously, none of us knew how things were going to pan out, but we all talk about, oh, what could we have done different in our research? What could we do different in how we presented things? How does the Fed communicate those kind of things? Do you guys sit around and, oh man, I wish I would have done that?
Unsurprisingly, for a large government bureaucracy, the Fed does a lot of retrospectives via huge memos. So if you want to think about, for example, what happened with inflation, there was a large, retrospective memo on how the inflation forecast evolved that actually got released with framework review materials in 2025. They are a very introspective organization in terms of they do want to know, like, what are we getting wrong? And they put a lot of thought and effort into that. In particular with 2021, I think they would have appreciated the strength of the labor market rebound a little bit more. If you think back to what happened in the summer of 2021, we had vaccines. There was this broad-based belief that, vaccines had arrived, kids were going back to school and all that. And then you sort of get into the fall, and all of a sudden it's like, we got Delta, we got Omicron, there's all these other labor supply risks. And so, we're not expecting the labor market to heat up kind of as much as I think it did. Sort of look at the VU ratio blowing out. That was sort of ex post. What everybody was recognizing was maybe the labor market tightness was greater than was understood at the time. In terms of the decision making, I think one of the things that's going to be interesting is a reevaluation of how much QE should have been going on during 2021. I imagine that Chair Warsh will take a look at that with pretty critical eye as a future thing. As a future review, it was something that's been actively discussed inside. I do think that there is still some truth, the claim at the time, which is sequentially inflation was going down. If you were looking at the month over month, it was very high in April and May, I think, of 21. And then it starts to go down on a sequential basis going into the fall. And then it just reversed. So for a long time, the transitory story sort of held. And, the chair has given speeches about this and things like that. And then it didn't. And they pivoted. I think if they had it to do all over again, they would maybe have pivoted earlier, knowing what we know now about how well QT could have been handled. They probably would have pivoted earlier and faster. At the time, you got to remember there was only one QT experience. It involved the taper tantrum. And that type of stuff looms large. I think that there was a lot of learning by doing. This was N equals 2 on stopping QE and doing a balance sheet runoff. So there was a lot that was learned in that one as well. And I think part of that learning is it's two-sided. It was the market. We learned that the market was comfortable with, they understood how this process worked. So anyway, I think that's definitely a part of it. Another thing that I would say was appreciated greater in retrospect. I remember having a conversation with Vice Chair Brainerd at the time. There was just a lot of soft indicators, a lot of anecdotes from businesses, a lot of having people in and talking to them about the economy, that inflation was a pretty significant problem there in the middle of 21, that the macro data, like I was saying with the sequential, that didn't quite get through. And so I think there was a little bit of a takeaway that some of these anecdotes, some of these high frequency data, it had some value that needed to be more appreciated than perhaps it was in real time during 21. That said, some of these high frequency indicators work really well when you have no data, second quarter of 2020, and really poorly when you have real data, like real government data. There's a limit to how much you can use.
I'm curious, a question on data, and just to quickly go back to COVID, was there any direct communication within the Fed and someone like an epidemiologist, or was the Fed just getting that information indirectly or through other government agencies? I'm asking because one of the things we did back in 2020, my brother-in-law happened to be an epidemiologist. Those of you who are longtime listeners, you remember Glenn Grossman, and we had him on every month. And so I'm curious with respect to policy, and obviously that was a big part of the path dependency on the economic outlook, how the Fed was or wasn't digesting that kind of information.
think it was definitely the case that we had outside experts that were consulted. I don't remember if there was formal, no, this person is going to brief the board type of stuff. I don't remember too many of those. We're obviously getting a lot of that stuff and devoting a lot of energy to, I remember there was a whole seminar series that kind of cropped up just on the research side about, oh, let's look at this model that embeds epidemiological information, or there is a fair amount of time series data nerdery inside the Federal Reserve. And so now we just had a bunch of new series to point at that. And so there was a lot of in-house analysis as well. It's definitely the case that 2020 and 2021 saw a much greater widening of the lens. What are we looking at? Have we considered this inside that model? Stuff like that. And I would say there are some parallel there to the financial crisis. In that moment, it's, what were we not looking at that we need to look at? For example, one of the things that everybody was drawn to right away was all of the cell phone-based data, the location-based data that was, are people going out? Are they moving? And how much does this relate to consumption and things like that? I remember seeing a lot of that type of analysis. It's just need is a great driver. And when you are trying to figure out the solution to a new problem, you start to widen out the lens of what you look at. And when you have 300 plus PhDs that are able to do it, that can widen rapidly.
All right, let's shift. I'm curious now what you think going forward with incoming Chair Warsh. What do you expect to change the most with respect to the Fed? He's been outspoken about communication, about the balance sheet, about the inflation framework. And what would you expect to stay the same compared to Chair Powell?
I think the first and quickest thing to change will be communications. The committee knows that the chair is communicating on their behalf, and that is a big lift. And I think that there is going to be a pretty fair amount of deference to what he would want to change about communications within reason. I think there are, for example, I think there will be a relatively concerted conversation around the dot plot. How are we communicating things like that? There are a wide range of views on the pros and cons of the dot plot on the committee, and a lot of effort went into establishing the summary of economic projections which happened in 2007, and to adding the dot plot in 2012. But there are questions about how much value this has, and is it serving the needs that we have for it? And I think he's raising some questions that can be dug into pretty quickly. Other communications aspects like the press conference, that's up to him. If the chair does not want to have a chair's press conference, there won't be one. But I also am of the belief that there is real value there and that he will see it, predominantly because if you think about the structure of the communications policy right now, the communications blackout extends through Thursday after the FOMC, specifically so that the press conference is an opportunity to get the message out once coherently. This is what the committee talked about in his thinking. This is how I would characterize it. Let me answer a few of your questions, and then let that sort of concrete set over the next 24 hours before anybody else starts talking. And that includes everything. So for example, like this morning, just in the last couple hours, we had the statements come out from Hammock, and I've seen Hammock and Kashkari so far, two of the three dissenters. They put out greater explanations of why they dissented.
Yeah.
Even those things they hold through that extended period in order to let the message set in. And I think he's going to see that there's value in that. And maybe that changed. Maybe he does less of them. Maybe he makes them more. I'm not sure. But that's definitely the thing that's easiest for him to change. I think the thing that's hardest for him to change is the inflation framework, if what he means by the inflation framework is the inflation target. So he's talked about, I want to have a big data project. I want to talk to the BLS. I want us to be interacting with the private sector. That's great. If he wants to come up with another measure of inflation, I think the committee is going to be interested in looking at a wide range of measures. I think he'll be reassured that the FOMC is already consulting a pretty wide range of inflationary measures. And the question is, if he's trying to move the needle on the inflation target, that's a thing that's done by committee vote, part of the consensus statement. It's been in since 2012. The idea that we're going to reevaluate the goalposts, so to speak, after you've been in above target for 5 years, coming up on 6 years. I think that's a very big lift, and that he would get a lot of pushback unless he approaches that very delicately.
Yeah. I feel like Fed policy sometimes can be thought of as like constitutional law. It's all about interpretation.
I think there's a fair amount of truth to that. You talked about the balance sheet. I think there is a lot of scope for him to come in and change how they approach balance sheet questions. I think there's an opportunity there for him to define, this is how and why and when we do QE. This is how we do QT. This is why we have the composition of the balance sheet that we had. These are our goals with that tool. I think that's a lane that is wide open to him to do reform, and also that there is some energy on the committee to answer some of those questions, both broadly in the sort of sense of what are our central bank goals for this tool, and also narrowly in the implementation pieces. I think the implementation pieces get a lot more discussion. You get a lot more from experts like Lori Logan and others within the system. I always like to point people to a speech that Chris Waller gave last summer. I think it was in July, where he laid out a broader framework. We're a central bank. We're using this tool. We have assets. We have liabilities. How do these things line up? What are our goals? What composition makes sense for us? I think that type of question is very much worth exploring, and that he'd have a good chance to do it.
Do you think any of Warsh's views on communication has to do with maybe being a little less direct, or trying to keep not being too committal? If you think about Greenspan, right? I think I'm going to paraphrase, right? One of his famous quotes is, "If you understood what I said, you've been mistaken," or something like that, or you misunderstood what.
Yeah. If you think you understood what I said, I misspoke.
Yes,
it's something like that.
And I feel like Chair Powell was very direct and very clear on providing the market his reaction function. And so you think that Warsh, one of his goals is to maybe pull back from that a little bit, just to not perhaps give the market a reason to be too confident?
It definitely sounds like that is one of his goals. He would just like everybody to give a little less forward guidance in general. I think that's, obviously he can control how much forward guidance is in a statement, but it's going to be pretty hard for him to control people answering questions like, what do you think is going to happen? I think that things like the dot plot can be re-examined through that lens, in terms of how reasonable is it for us to be putting a dot in 2028 Q4 for this is where we think the policy rate is going to be. Do people feel like they're providing real information to the public through something like that? But at the same time, I want to definitely agree that Chair Powell has tried and succeeded at being very clear about what the reaction function is. I think that's helpful. One of the things that I think is underappreciated is that the bulk of market moves do occur on data, not on communications. And I think you really have a communications problem if that flips, and it doesn't. So people are reacting to what they think you're going to do. And generally speaking, I think that those reads have been fairly good in recent years in terms of market reactions to, say, labor market and inflation data. So I think there is something to be said for as much clarity as you can get your arms around in terms of the committee's reaction function. We'll have to see how he pursues that. A case can be made that there is a cacophony of voices, and that's not always helpful. I think in general, though, the communications framework as it exists today works to explain the reaction function pretty well.
All right, Kurt, let's talk about the here now. In your first couple of weeks, you've had now your first FOMC meeting at Piper Sandler. What are clients focused on? Obviously, the market doesn't have any changes in Fed policy priced in for a while. And as you mentioned, we're going to continue to remain data dependent, chair dependent now going forward. So what are clients asking about, and what are you telling them?
One of the first questions that I get is, can Kevin Warsh get this committee to implement cuts? And I think the market read on that is fairly accurate, in that it is not likely that he is going to be in a position to convince them to provide cuts anytime soon. I think that Chair Powell has communicated pretty effectively that they are waiting for the resolution of the tariff bet they already made. So if you look at where core PCE, why core PCE is running just above 3%, a big chunk of that is that goods inflation is way higher than it had been in the past, and it's actually been accelerating in recent months. And so they believe on the committee, as has been communicated in the last two press conferences, that those tariff effects on inflation should be winding down, and that will exert some downward pressure on inflation going forward. They've already brought rates down quite a bit. And then the last three cuts last year was basically based on this assumption that they're right about the tariff effects. And that's why inflation was being held up in the second half of 25. And now they want proof. So he's going to be facing a committee that is 18 people who have entirely, I believe, the entire committee has been there for the majority of this fight. They've been there while inflation has been 3% or higher, and they were there for, in many cases, team transitory, and they were there for last year when they said, we're going to look through this and cut 3 more times. So I don't think they have a lot of cuts in them until they see that stuff, until they see the tariff coming through. And that's even before the oil shock. So to the extent that the oil shock passes through into core and they have to also worry about that, or the extent that it's affecting inflation expectations, they have to worry about that. So he's got a tough row to hoe in terms of, if he's coming in and he does want to try to get them to move down, I think he probably recognizes that and is going to come in and work to stand you. Building those relationships is going to take time. It's a lot of time and effort goes into that. The chair spends a lot of time trying to make sure everybody feels heard and everybody's position is fully understood. And that is how you build consensus. And I don't think he is in a position not to at least try to build consensus. I don't think he'll have the votes.
Sure. And I'm going to ask you to make a separate forecast. Do you think President Trump is going to give a future Chairman Warsh a honeymoon phase, or you think he's going to be tweeting at him as soon as he sits in that chair?
I don't know. I was actually surprised how low key he was these last couple of days after Chair Powell announced he was going to rotate back to being a governor and stick around. That didn't invite as much invective from Truth Social as I would have expected. So maybe he's, I don't know if we want to say, learning the limits of shouting from on high in terms of having an effect on the institution. But I would imagine it is a matter of time. So the honeymoon phase, I think he gets a little bit of a honeymoon phase.
A little benefit of the doubt.
Yeah, I'll stick my neck out. I think nobody really wants to be in the presidential mood prognostication business.
Kurt, thank you so much. This was super informative, and I hope you enjoy your honeymoon phase here at Piper Sandler.
All right. It has been very enjoyable so far. Thank you guys for having me.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.